What we saw yesterday, what does that mean about the Fed's path moving forward? What does that mean about the economy? And also, what do you think that means for investors in the markets?
Sure. So I think in terms of the Fed's path, so I think we're still looking at a July rate hike as our base case. So the Fed telegraphed this pretty well. I think this was also just part of that brokered compromise between that June pause. And so I don't think that even the softness that we saw yesterday is enough to really convince the Fed that they have quite done enough. I think they want to make sure that we see that downshift in inflation that we saw in yesterday's core maintained. So I think we still go for July, but I think it does suggest that that's likely to be the last hike this cycle, because I do think that we can see those roughly 0.2% monthly increases in the core CPI be sustained over the next few months.
Thomas, same question for you.
Yeah, I think that the markets are basically, the forward markets are indicating a 25-point rise next time, but then a zero. It's growing at zero after yesterday, actually, after the data came out yesterday. I think the big issue for the Fed is the core that is still pretty persistent. It came down a little bit yesterday, but the big sort of overhanging problem for the Fed is housing, which is the biggest component of core CPI, 40%, but it's also the worst measures. And it appears that rate hikes are essentially inflationary in that sector, which might seem strange, but we have housing prices going up in Case-Shiller, and we have construction booming with rate hikes currently taking place. And I think one explanation for that is that the supply of housing has gone down with the rate hikes. People are sitting, 60% of market are sitting on mortgages financed during COVID with very low rates, so no one wants to move. And existing home sales is about 90% of new sales of homes. So there's a huge supply reduction in the housing market, which has led to two things. One is prices are increasing as opposed to decreasing with rate hikes, and construction is up to make up for that lack of existing homes being sold.
Okay. Thomas, I want to stick with you for a minute. Are we at risk with one or maybe even two more hikes of creating a situation where the Fed overshoots its 2% target and we create a deflationary environment?
Yes and no. Again, like I said, the housing component seems to be working in the opposite direction, where rate hikes have now increased housing prices as opposed to decreasing them by cutting supply more than it's cutting demand, essentially. But it is a general fear here that the Fed is overdoing it. And this recession would be kind of unique in recent recessions if we actually get into one. It's not clear yet, but if we do, because the government is not going to step in with the House of Representatives basically going to resist too much of a stimulus here like we did during COVID. So it's going to be a pretty interesting recession in terms of lack of government response to the recession.
So, Sarah, is the Fed at least at risk of overshooting and creating what many people are fearing could be a deflationary environment?
So I think that that's certainly the risk, that the Fed's perhaps overdone it or will overdo it. And I think that's why you are seeing this debate heat up more amongst Fed officials, that they may have done enough already. In terms of whether we're going to be getting into a deflationary environment, I'm not so worried about that. I'm more worried about that while we do have a lot of disinflationary pressures in train right now, and we do think that we'll see some more market improvement over the rest of this year, that it's going to be a lot harder to get from, roughly 6.5% on core down to a little under 5%, like we've seen since last September. We're not going to see that same pace of disinflation ahead. And, as Thomas pointed out, we're already seeing some rebounding and some firmness in the housing market. And so I think that's going to suggest that we have, in some ways, less disinflationary tailwinds as we move out further into 2024. And you're not going to get inflation fully back to 2% in a timely and sustained manner.
All right, so a lot of expectations for yesterday's CPI. We do have PPI today, but I want to ask you guys, earnings season, including the big banks coming up tomorrow, do you believe that has any impact on the Fed's decision in the meeting coming up just under 2 weeks from today? Thomas?
Well, it should have, because there is some stress in the banking sector, not as much as we predicted a couple of months ago. But I think the overriding concern is for the Fed is inflation. That's kind of where they're looking. And the PCE is going to come, which is their favorite inflation measures, coming out the Friday after their meeting. So this is kind of the last week we had yesterday on inflationary metrics before they go into their meeting. But I think the overriding concern is certainly inflation and not banking.
Sarah, same question. Earnings season, does that have any impact on the Fed, or is whatever we saw from CPI, is that going to guide their final decision?
I think what you're seeing in terms of some of the earnings, I think that's going to be secondary to what we're seeing in the Fed's primary mandates, inflation and the labor market. So it'll be a piece, they'll be paying attention to it, but I think it's going to fall secondary to what we're seeing in those main actual economic data.